Hey, interest rates and US policies seem to be stuck with no way out. That's because the Fed, or the US central bank, has openly said that President Donald Trump's policies are like throwing fuel on the fire, setting the stage for a new inflation crisis. In this situation, the ones who are going to get hit the hardest are American consumers, but you can bet the rest of the world won't be spared either. Because right now, what's brewing beneath the US economy is already starting to smell pretty bad. Whether it's rotten credit card debt, $750 billion in real estate sector debt, or the massive current account deficits of banks across the US, over $500 billion already. And then there's the bond yield on US government bonds, which is about to hit a new peak again. Let me tell you, this time, assets are really at risk. If you don't like the stock market, it's to the point where you're in trouble. You can support the research for this video by scanning this QR code. The proceeds go directly to supporting my channel, helping it grow strong. We've come this far thanks to all our supporters. Thank you so much. Or you can support us by subscribing, so I know whether the research I put in, even when it's done on a tight budget, is actually useful to everyone. Do you want to know more? Your support will encourage me to keep doing research. Or you can just watch until the end and enjoy it with me. FinSci Money Monster, we stop for nothing. Investors might want to scream at this news because Bloomberg has reported that the Federal Reserve, or the US Central Bank, has given an official wink and a nod, signaling that US policy interest rates might have to be put on hold or just kept as they are. They might not be lowered. CNBC also reported on the official results of the Fed meeting as well. All of Donald Trump's various policies are like adding fuel to the fire, potentially sparking a new wave of inflation. For example, his policy of mass deportation of immigrants could cause the US minimum wage to skyrocket to the moon. And then there are the protectionist trade policies and trade wars, with the US planning to slap tariffs on 60% of Chinese goods and another 10% on G7 countries, north, south, east, west, you name it. As for the exact percentage of these new tariffs, this policy will make goods imported into the United States significantly more expensive. And the first people to get hit with bad luck will be the ordinary consumers, the hardworking American public themselves. Because even now, with the previous round of inflation, prices have already gone up and haven't really come down at all. Americans will have to keep swiping their credit cards just to buy basic everyday goods and essential food items. People are using their credit cards at home so much that they can't keep up with their debt payments anymore. This has caused household debt in the United States to soar to record highs. Seriously, if Donald Trump says he's going to raise tariffs and impose trade barriers on everyone, claiming it will bring manufacturing back to the country so people can consume and use domestically produced goods, how can things made in the United States possibly be cheaper than imports from China? It's probably possible, but it's definitely tough. And the fact that the Federal Reserve, or the US Central Bank, has said that they might not cut rates, or if they do, it won't be as much as they projected last year, that's a huge deal for the global economy and finance. The things I just mentioned, there are three major issues happening in the US right now, right? Whether it's bad debt, record high credit card debt, or real estate sector debt. In the US, it's as high as $750 billion, and the payment is coming due soon. It's estimated that the account balance of banks across the US is $500 billion. Let's go through these one by one. We'll start with bad credit card debt first. As I mentioned, prices have gone up, but wages haven't kept up with those price increases. So for many Americans, when their income hasn't come in yet, what they have to do is use credit cards, swiping those pieces of plastic to buy essential goods and necessities for their households first. But when they keep swiping more and more, eventually it gets to the point where they can't pay it off. That's why there's now so much bad credit card debt in the US. At this moment, it's the highest it's been since 2010. Let's take a look at this graph. This shows the bad credit card debt in the United States. The last three bars, 2022, 2023, and 2024, have grown exponentially. The last bar is as high as $46 billion. This is the figure for bad credit card debt in the US. And as I mentioned, the reason it's gotten this high is because people's incomes haven't kept up. Incomes have gone up, but not as much as expenses or the cost of living that people have to pay. And the interest rates on credit cards in the US are no joke. According to data on the average credit card interest rate in the US, as of December 2nd, 2024, the rate is as high as 24.37%. That's really expensive, almost like borrowing from a loan shark. So, for example, if an American swipes their credit card, if they spend $100 and only pay the minimum, they'll end up having to pay back $124.37. And that's with interest compounding on top of itself. Meanwhile, the US federal funds rate is currently at 4.5%, but credit card interest rates are already at 24.37%. The default rate, or bad debt, on credit cards has now reached $46 billion. So if the policy interest rate can't go down, it still hasn't dropped. People just can't handle paying even higher interest rates than this. And even if the interest rate just stays where it is now, even at this interest rate, people just can't take it anymore. The amount of bad debt has already risen to $46 billion, and it's likely to keep going up. Next, let's talk about the accounting losses of banks across the United States. This is actually a bigger deal than the bad credit card debt. According to the FDIC, banks across the US are now facing accounting losses totaling $512 billion. Here's what's going on. Most banks in the United States invest a large portion of their money in US government bonds. But when interest rates go up, the value of those bonds they invested in drops. That's why there are such big accounting losses. If interest rates don't come down, the value of those assets will just keep falling, and the accounting losses will remain. That's why everyone is really hoping, wishing even, that the Fed will finally lower interest rates so these accounting losses can be reduced. That way, the losses could recover. These accounting losses in the US are actually the main reason behind the bank runs and bank failures that happened in 2023. If you remember, 34 banks collapsed. Martin Gruenberg, the chairman of the FDIC in the US, said that American banks are facing downside risks due to economic uncertainty. Political developments and interest rates, when you put all 23 of these factors together, they present significant challenges for credit quality, which will have a direct impact on the liquidity in the US banking industry system. And if we talk about debt that's even more pressing than bad debt, credit cards, and accounting losses for US banks, it's the debt from the US real estate industry, which now stands at $750 billion. On top of that, a large portion of this debt is coming due very soon. If government policy doesn't successfully bring down interest rates, it'll make it really hard for the real estate sector to issue new bonds to pay off old debt because interest rates still haven't come down. Or take those in the real estate sector who took on significant amounts of debt when rates were low. Now that rates are high, some might just default on their loans. And this kind of debt could have a potentially devastating ripple effect on the stability of major US banking institutions, because the $750 billion in real estate debt is mostly held by banks, right? And if interest rates stay really high and building owners or landlords decide, forget it, I'm not paying, just let it go, the ones hit the hardest will be the US banks again. And if the banking sector takes a hit, whether from accounting losses or from this massive amount of real estate debt where people just refuse to pay, the banks are in trouble. Right. And if the banks don't make it, then businesses relying on bank loans won't make it either. Now that we're here, can you see how big of a deal it is when the Fed says it won't cut interest rates? It's a massive, earth-shaking issue for the US banking system and the economy as a whole, especially considering that in late 2024, the Fed signaled it would cut interest rates. But now, in 2025, they're saying, nope, no rate cuts anymore. And even if there are any cuts, It might only be once or twice, and the cuts won't be as much as previously targeted. It's very likely that by the end of 2025, the US policy interest rate could still be above 4%. Let me tell you, a high policy interest rate is a nightmare for risk assets. Risk assets just don't like high policy rates, whether it's cryptocurrency or the stock market, because when policy rates are high, what follows US government bonds will also offer high yields or returns. And no matter what news comes out about US government bonds, they're still considered a safe haven or safe asset. According to general investment principles, if a safe haven or safe asset offers high returns, money will flow out of risk assets and into safe havens. Citigroup has even reported that within the year 2000, this year we're likely to see 10-year US government bonds offering yields or returns as high as 5%. This is a result of rising inflation combined with the US government's deficit spending. So is inflation really high? Well, as I mentioned before, with Trump's policies, it's probably going to be high. And what about the US government's deficit spending policy? Will it be high? Because if it gets even higher, it'll just push inflation up even more, right? And then they won't be able to lower interest rates. Let's take a look at this news. Running a deficit budget basically means borrowing. So if you want to ask whether they'll run a big deficit, just put it simply. Are they going to borrow a lot? If you want to know whether they'll borrow a lot, just check out this news right here. Just in early January, the United States issued an additional $119 billion in new debt. That's just in one go. So let's take a look at where US bond yields are at now. The yield on the 10-year US Treasury bond is currently at 4.73% and is heading toward 5%, which is back to the peak we saw in October 2023. Like I mentioned before, if US government bonds are offering returns this high, money is going to flow out of the stock market and into the bond market. So if anyone asks whether the US stock market will grow a lot this year, given this kind of monetary policy, just looking at it roughly, the answer is that it might grow, but a big surge, probably not. Because there's a simple principle in the stock market. The stock market grows only when there's capital inflow. But from the beginning of this video, we haven't seen any reason for money to flow into the stock market. If anything, it's more likely to flow out. In this video, I'll explain how money can flow into the capital market, which would give the market a chance to grow or not. There are three main channels. The first is through borrowing. But right now, interest rates are high, which means the cost of borrowing money is expensive. On top of that, there's a lot of bad debt, so banks are reluctant to lend. So borrowing is expensive and getting a loan is tough, kind of like what's happening in Thailand. The second channel for capital inflow is from investors, like when people buy stocks. But as I mentioned, if interest rates don't go down, government bond yields will stay high. That means investor money will flow out of the capital market. They move their money to the bond market, which means money is flowing out of the stock market again. And the third channel is money coming in from customers. But these customers, consumers and all, like I said, are already drowning in credit card debt. They don't even have enough money to pay off their debts. And on top of that, there's inflation. So they have to save whatever money they have left just to buy essentials for daily living, to put food on the table for themselves and their families first. So when it comes to spending on non-essentials, there probably isn't any money left for that either. So when you look at the three channels of capital that could flow into listed companies in the stock market, it's clear that it's pretty hard to see how any of that money is going to make its way in. So the next question is, well, is there a chance that the US stock market could crash? I honestly don't know. I can't answer that. But if you ask whether it's expensive right now, that I can answer. Because the PE ratio of the US stock market usually averages around 18 or 19. The PE ratio basically tells you if you invest your money today, how many years it would take to get your money back. On average, the PE ratio of the US stock market, the S&P, is usually around 19 years to break even. But right now, the PE has gone up to 26. So from what used to be 19 years to get your money back, now it's 26 years. So is it expensive? Yes, it is. Just look at Warren Buffett. He's still selling off a lot of stocks right now, and he's holding up to 30% of his portfolio in cash. You can check out this clip about it. So if you've watched up to this point, you can sum it up like this. First, US stocks are currently trading at high valuations and have significantly diminished potential for future growth because capital is flowing out. Is there still a chance for growth? Yes, but it is quite limited. But everything I've talked about up to this point, I can say that what's happening right now is something that's happening in the current period, and it might only have a temporary and relatively short-term impact. Or maybe in the medium term. Because everything I've talked about so far has been on the negative side, right? So I have to share the positive side too. Take a look at this chart. It shows the growth of US stocks, specifically the S&P 500 market. You can see that it's been growing steadily to the right. No matter what crisis happens, like the dot-com bubble, if you look at the big picture, it just looks like a price correction. Same with the hamburger crisis, the US subprime mortgage crisis, you see it was just a market correction. If you look at the big picture, even when COVID hit and the market dropped a lot, it was still just a correction. After that, it bounced back up again. So what's happening today, yes, it might cause a crisis, or maybe it won't. If a real crisis does happen, the stock market will definitely drop, but that will be an opportunity for people who are prepared to go shopping for quality assets at bargain prices. Normally, in the bigger picture, the stock market keeps growing anyway. But you never know, statistics are just the past. Who can say? What if World War III breaks out? Everything would probably collapse too. So everything I've shared here, I didn't mean to scare anyone. I just want to give you the information so you can be prepared. Because people who aren't ready when a crisis hits, they'll just get swept away by the crisis. But those who are prepared when a crisis comes, for them, it's just a chance to go shopping during a summer sale.